Good afternoon and welcome to SIEPR's first event of the 2015 to 16 academic year. Just FYI that I am not John Chauvin, but instead Mark Duggan, the new Trione Director of SIEPR. I'm delighted to be succeeding John in this role and very excited to be here today for our first event with Glenn Hubbard. So let me just spend a few minutes introducing today's speaker, Glenn Hubbard. As I geared up this summer to take the baton from John Chauvin, I knew it was a daunting task, and I knew it was going to be very, very important to assemble an outstanding lineup of speakers. And I'd say one thing that has made SIEPR really special over the years is its ability to bring together people from academia, from the business world, and from policy. And here at Stanford, we have a number of people who really excel on that front, on bridging those three worlds, including John himself and our honorary chair of the SIEPR board, George Shultz. But I honestly would be hard-pressed to think of anyone from our peer institutions out east who so effortlessly bridges these worlds as Glenn. He's done extremely important research throughout his career on a diverse set of topics, including the sensitivity of firm investment decisions to cash flow and the distortionary effects of means-tested social insurance programs. He's an influential scholar who's published more than 100 scholarly articles, and he's focused exclusively on issues that are hugely important for governments and for business and for the general public. So I've clearly spoken long enough, and John Chauvin, I asked him for advice in my first event because John is away today, and he said, end on time. So I want to stay on that track, and so we should get to the main event and welcome Glenn Hubbard, who's going to tell us how to make financial regulation work, a topic that seems pretty important at this time. So welcome, Glenn.
Thanks so much, Mark. And I have to tell all of you, you are very fortunate and in good hands. I have known John Chauvin forever, but I can tell you that Mark Duggan is going to be a great head of SIEPR too. So you're in very good and very safe hands. I know that when economists come to give talks to audiences that include business people, there is always some desire or some pressure to introduce some kind of forecasting or telling the future. That really isn't so much my job with you this afternoon. George Bush once said about me that Glenn can't even predict the past. And I think what he meant by that was data get revised, or at least that's the way I heard it. But I'm going to stick to what economists feel better at, which is talking about the long run and how to get a better long run. You know, the issues that face the financial system and financial regulation are very familiar to us. You know, interestingly, if somebody came in from Mars and looked at current economic data, the individual coming in from Mars might say, well, things look kind of okay, right? The economy is growing roughly at what many economists think potential GDP is. The labor market's tightening. It's not okay. And I think we understand that. And part of why it's not okay is the nature of what a financial crisis is and what tail risks are. And I'll argue with you this afternoon what government policy has done in response. I think there are ways in thinking about policy over the past several years that will be very pertinent to the talk this afternoon. We have been in a policy framework across a lot of areas that seems to suggest if we can make a series of short-term changes, the long-term will right itself. I have a very different general view of policy, and will argue with you a very different view on financial regulation this afternoon as well, that if we actually get the long-term right, it's the short-term that will take care of itself. The financial crisis is the searing event for a lot of people's lifetimes. For the younger people with whom we work in the universities, this is like the searing event the Depression was generations ago. Like many searing events in American financial history, it has led to a regulatory frenzy. And I guess two questions one might ask is, could it, meaning a crisis, happen again? And are we on the right path? The short answer to those questions are yes and no, but I'll take a few more minutes to elaborate. Now, I'm going to get three unusual sources of wisdom this afternoon because it's late in the afternoon and you all get to drink a glass of wine while I'm talking. And so the first is actually the Grateful Dead. The second is QE, not quantitative easing, but the Queen of England herself. And the third is the best picture I could find online of a nuclear power plant. Now, the Grateful Dead, I'm of course thinking of what a long, strange trip it's been. I think when we're going to think about financial regulation now, we're going to have to step back and ask, how did we get to the mess that is being presented to us? The Queen, in my view, asked the best question in response to the financial crisis. Now, I know that she may not look like a typical professor given the various diamonds, and I'm sure she was carrying a handbag and wearing white gloves, but when she went to a building dedication at the London School of Economics, after meeting with the various worthies, she asked the question, why did nobody see it coming? And the room got very quiet. The Queen could have come to my institution, probably this institution too, and asked the same question. I think we need to talk about that. And then the third is maybe when we're thinking about financial regulation, we're thinking too far inside the box. That if we are interested in problems of extreme tail risk and systemic risk, maybe there are other regulatory frameworks, for example, nuclear power and nuclear accidents, that offer some guidance. So some framing thoughts. First, finance is a big deal. That's probably shocking to hear from a finance professor. I guess I'm dressed today as kind of a New York WASP banker, just to give you a feeling of what one looks like. So finance is incredibly important. The reason finance is important is that it matches savers and borrowers. It is what facilitates economic growth, and an efficient, low-cost financial system is what we want. The financial system is in many respects plumbing. I don't usually put it that way in New York because that sounds very unsexy to audiences of bankers. But I say that with no disrespect because, try living without plumbing. And the disruption of plumbing leads to crises, and here it is here. The problem is that the public support for an efficient, low-cost financial system really gets compromised when people worry that the sector is too large as a share of the American economy, which it was prior to the financial crisis, and that systemic risk is being mispriced or ignored. Regulation is often portrayed as portraying a somewhat saintly role of rescue. My own view will be a little more skeptical of that regulation may have had a role both in the run-up to the crisis and certainly problems after the crisis. We've seen this play before in other sectors. For example, if you looked at 1960 to the present, finance went from about 4% of GDP to 8% of GDP. There's another sector we think a lot about, Dan and I have written a lot about, in healthcare, that grew from 5% to 18%. It's not a coincidence that I'm raising those two industries with you. Both are important services. Both have characteristics of asymmetric information and conflict of interest. And in both cases, the buyer is not paying the entire cost of a service. In healthcare, that's about third-party pay. In finance, it's about mispriced risk and taxpayers carrying burdens that are not priced. So why did we have the financial crisis? This really gets to the Queen's question. If the former is about the long, strange trip, the why did nobody see it coming? There are really three stories that have been bandied about. One, which I have a great deal of sympathy for, is that global trends just created a perfect storm. I have in mind three that I'll come back to. One was a big imbalance in saving and investment globally, a series of monetary policy mistakes in the United States in the early 2000s that led to too expansionary an economy and mispricing of credit. And the third was regulatory arbitrage. There are, however, two other stories. One is about deregulation, that somehow deregulation is at fault and it unleashed a lot of entrepreneurial opportunities for rogues. I think this is the bottom line of much of the media coverage of the crisis. In either of these stories, whether you take the economic bent or the media bent, regulation's neither entirely innocent nor a savior. We know that before the crisis, regulation played a big role in housing finance, mispricing credit in that sector, and in introducing something I'll talk about this afternoon as run-prone contracts. the contracts that were internally flawed and likely to experience risk. Dodd-Frank, after the crisis, I will argue with you, was not the right medicine. Parts of it were irrelevant. The Volcker Rule really had nothing to do with the crisis we went through. Parts were downright perverse. The Financial Stability Oversight Council, and then parts were just a missed opportunity that we didn't think about an entire regulatory framework. So what kind of framework should we be thinking about? Well, the most common question that gets asked in finance about regulation, particularly after the crisis, is should we have more? Or is this a debate more regulation or less regulation? I don't really think that's the right question. The question is, what's the regulation and how effective is it? And to get at that, we really have to go back and ask, well, what actually happened during the financial crisis? Because we don't want to take a set of actions that wasn't even related to what we went through. And how does understanding what actually happened shape the discussion of regulation? The problem is this. We've actually, I think, gotten the regulatory answers wrong by first fighting the last war, which is very common in regulatory policy, and of not addressing what I'll talk to you about this afternoon as 3 R's that are very important: runs, risk, and regulation itself. It's in this context that I'm going to come back to in a few minutes nuclear power and thinking about tail risks and how to manage given the nuclear analogy. Now, stepping back, what are the 3 runs? If the person came in from Mars and said, okay, explain the financial crisis in an elevator pitch, I would say, well, the first thing is a run. What distinguishes a financial crisis is almost always a run. Nobody can talk intelligently about a financial crisis without working in a story about what economists would call contagion. In this particular financial crisis, the run didn't start in the place you see in old textbooks. You know, in old textbooks, you see lines of people outside a bank in the 1930s. That's not where the run came from. The run came from so-called shadow banks, people who were engaged in maturity transformation outside the banking sector. Regulation had made that a very profitable opportunity, and people were pursuing it. But that run then almost spread to the largest commercial banks. That, in a nutshell, is the crisis. The second R feature of the crisis were risks, in that risks were mispriced in the run-up to the crisis. I mentioned earlier monetary policy mistakes. Periods of very low real interest rates tend to be periods also of spread compression. And we saw mispricing of risks in that period. We're seeing it in some sectors of credit markets today. And then the third is regulation. I would argue that regulation had 2 contributions to the crisis in a non-healthy way. One was before the fact, that regulation encouraged a great deal of risk-taking, particularly in contracts built on housing finance, because politicians had believed that was very virtuous. I remember George Bush once said to me he had a goal of having much higher home ownership. I replied, as an economist, I didn't particularly care. He said he could tell which one of us had life tenure and which one had to run for re-election. So housing is very, very, very popular. But what I'm worried about with you more this afternoon is a kind of ex post ad hocery, that once the crisis happened, regulators essentially winging it made the damage a great deal worse. So the crisis as a run. Typically, in financial regulation, if you were to engage, quote, serious people, people who thought about this a long time in the Fed system, or people who advise commercial banks, they would say, really, you need to focus on 2 things. One is capital adequacy. Does an institution have sufficient capital to buffer against risks that it has taken? And the other is prudential supervision. Now, this goes way back in American banking history. There is an expression in banking regulation called call reports for banks. The name call report comes back from the 1860s, where literally a regulator could call for the report at a moment's notice. So there was no attempt or no probability of window dressing. And capital in the old days in commercial banking was actually quite deep. Bank owners actually had personal liability as well in the management of the bank. But there is still a belief that if only we got capital rules right and the regulators were more efficient, we'd be better. Now, the actual crisis is a run. In a run where fire sales of assets happen, I would argue with you that if we did double the capital in the commercial banking sector, we might well have still had a real problem. Capital alone won't do it. So the second level that people point to is, well, it's interconnectedness. So the government had a massive intervention in AIG, it's a major property and casualty insurer. AIG did not get into trouble in the insurance business. It got into trouble because it had a unit called AIG Financial Products, and it was essentially engaged in large-scale speculation. The argument for the intervention in AIG was interconnectedness. So we didn't know who's on the other side of all the AIG transactions. To make a long story short, economists who've gone back to look at this argument don't find a lot of support for interconnectedness views, that it is not the case that AIG's issues would have been because of these pairwise matches. Rather, you can think of it as more of a contagion story. Interconnectedness is like a domino game. So interconnectedness says if I fail because Mark was my counterparty, he fails, and then Greg, and so on. The contagion view, I think, is best described when Gary Gorton, who's an economist, talked about it as a virus in a salad bar. So there's a virus in something in the salad bar. What's your most intelligent response to my telling you that is probably to pass on the whole salad bar. Well, that's what contagion is. So I know there's a problem somewhere, but I'm just going to run to cash everywhere because I don't know where the virus is. So really, in that world, as opposed to a world of interconnectedness, which is where regulators have been focused, the failure of a given bank, call it Bank 1, then would cause investors to shun Banks 2 and 3, even if they had no direct exposure to Banks 2 and 3. So that's a very, very different story, but one that I think in the underlying economics is the one to fix. Now, what about the mispricing of risks? Again, we had some slow-moving underlying issues here. The global saving and investment imbalances led to very low levels of world real interest rates. And I can tell by looking at all of you that your favorite course is economics. You just have that look about you, economists and non-economists alike. And you go into a group of econ students and you say, okay, the real interest rate is too low for too long. Tell me the price of which kind of asset is going to rise. Well, simple bond math tells you it's the ones with a long life. So the global housing boom was kind of baked in the cake of that argument. People focus a lot on government-sponsored enterprises in the United States, but the house price boom was a global boom, and its turnaround was also global, and it came from this slow-moving feature of capital markets. The monetary policy excesses led to very profitable carry trades generally in finance, but in this particular case made it profitable to have teasers and new kinds of mortgages that profited from that carry trade. And then regulatory gaps that if you didn't like what one regulator said, you could just try to go somewhere else. A second problem in the mispricing of risk is it is an issue economists are increasingly focused on, that there's actually a very large demand relative to supply for safe collateral. And I put safe in quotes because I'm about to make some comments about what is and isn't safe, but there's a huge demand for essentially default risk-free assets. Now, traditionally, we think of the canonical default risk-free asset as a U.S. Treasury obligation, although I would point out at ADP, we were a AAA credit long after the United States. We gave it up for business reasons. So, but still, it is a safe, allegedly safe asset. The problem is we saw in the years going into the financial crisis a number of assets that had the same rating as the safest asset that had higher yields. Well, going back to that favorite course of yours, that just shouldn't be. I can't have something with identical risk and different prices. And those dodgy substitutes were a large part of the issue because they were still alleged by regulatory purposes to be safe when in fact they were not. Government's role in this was really two. It actually actively promoted risk-taking in primary markets. Housing was the particular example. It was an article of faith of public policy that we needed to have large subsidies for housing that ranged from the mortgage interest deduction to cheaper credit through Federal Housing Administration and the GSEs. And then after the fact, in financial instruments through both guarantees outright and a series of essentially government puts to the taxpayer if anything went wrong. So this was a cocktail going into the crisis that was generous, or that was general. Now, in terms of the regulatory problems, if you were to go back and look at U.S. Financial history, you see it as a cycle of a pattern of a crisis, then there's a regulatory response to that crisis, then the financial system, as it does in the private sector, innovates, and then there's further regulatory responses. So the founding of the Federal Reserve came about from a series of financial crises where it was clear we didn't have a lender of last resort. That's why we have a Federal Reserve. Deposit insurance came about because of the desire of giving people safe short-term assets in banking crises. The political economy of deposit insurance is a little more sinister. It tended to be because the U.S. had a unit banking system, and a lot of small banks liked the idea of deposit insurance because they didn't have the geographic diversification of large banks. And then more recently, well, obviously in the 30s, the SEC's founding was due to misrepresentations in the Great Depression. More recently, the PCAOB, Public Company Accounting Oversight Board, was in response in the Sarbanes-Oxley legislation to corporate accounting scandals. The Consumer Finance Protection Bureau, which is in Dodd-Frank. You see this pattern. And in general, as my colleague Joe Stiglitz is always reminding me, we need to do this to correct for financial market inefficiencies. I guess I'm not sure that that's why this process is happening. I mentioned the two ways in which regulation was a downright contributor to the crisis. First, I would put the put options in these contracts that taxpayers were on the other end, which meant that the risk was being mispriced, because I don't bear all of it. The taxpayers pay if I lose. And the designation of so-called systemically important financial institutions. About this term, which has become popular, SIFIs, or conservative friends of mine call them sci-fis, but SIFI or sci-fi, whatever you'd like to call it, two things are worth saying from an economic perspective. Nobody should be too big to fail. And I'll come back to that. Zero. In a capitalist economy, I don't care what kind of firm you are, you can be in financial services, you can be in tech, doesn't matter. You should not be too big to fail. The second is, what is the problem in finance is not institutions, it's contracts. And so the issue of designating some institutions as systemically important misses the fact of particular contracts that I'll come to. I should give you a disclosure. I am a MetLife director. We are suing the government over this definition. So this is an area in which I have some passion. And I would argue that there's a questionable regulatory framework. We have in mind a regulatory philosophy. Dodd-Frank is the crystallization of this philosophy. It says you need complex ex-ante rules. So before the fact, a whole bunch of thou shalts and thou shalt nots. But after the fact, just very simple ex post commitments. So you just say, quote, we won't intervene. Now, I'm going to argue with you. I think that gets it exactly wrong. So what are some potential ways forward? Well, there is one group that says, well, if runs are the problem, we just won't have runs. Well, one way not to have runs is by expanding the government safety net. So just as deposit insurance made it clear it's not worth lining outside of Citibank or JP Morgan Chase, and nobody did that during this past crisis, maybe we just need to have a bigger safety net. That is, in fact, what we're doing in some respects. That, of course, puts the taxpayers on the other end of that transaction, and it also undermines public support for finance. A second area would be really radical changes in contracts. These primarily come from the academic world. And in fact, some of the best work in this area is actually being done here at Stanford on really substituting equity-like contracts for many of the debt contracts. The third area would be some contractual changes, but a different regulatory framework. And I say that I know this sounds like a State Department memo. So a State Department memo has two options that are clearly never going to happen in the world, and the third option is what the briefer wants the president to look at. So it's the third here that I think is reasonable, and that's what I'm going to talk to you about. But as I say, a lot of people here are working on number 2. The safety net. Again, the underlying issue when you think about runs is that some contracts, particularly in short-term debt, are prone to run. That would be true if those contracts were written in small banks or in large banks. Sometimes people who worked on Dodd-Frank, I think, need to go back and look at their financial history. In the Great Depression, the large banks were not the majority of the failures. The failures were all the small unit banks and a lot of correlated risks, because it was the contracts themselves were the problem, not the size of the bank. The fear in designating so-called systemically important institutions is that you're doubling down on this idea of too big to fail, and then hoping to get your way out of it by a series of micromanagement, either higher capital or different rules for these institutions. I think that is a fool's errand. The increased safety net idea is also very expensive. We paid a large price in the savings and loan crisis. We paid a vast price in the most recent financial crisis. The more we widen the safety net, the more we put the taxpayer on the hook. That has 2 costs, one of which is obvious, the other's less obvious and maybe even more important. The obvious one is that it costs a lot of money. But the second one is that it really undermines public support for what I said at the beginning is the good finance, that finance that actually gets money from savers to borrowers. And then, of course, this expansion of the safety net will just increase incentives for risk-taking by essentially widening the government's put. People who studied the past financial crisis concluded that as much as $100 billion of put value was created in the widening of the safety net, which just led to further bloating of the financial system. So run-free contracts. We start with an example that's got to hit close to home here. We had a tech bubble at the turn of the century. I'm not commenting on whether we have one now, but we had one at the turn of the century. It didn't cause a financial crisis. So tech prices went down a lot. The economy barely noticed. Hint, when everything is equity financing, there is no run. The tech bubble that we went through in the early part of the century was equity financed. Now, that's led some people to say, well, why don't we just port over that intuition to banking? Why don't we just have a very narrow banking world in which banks literally hold just reserves, and any financing of lending is just done entirely with equity? That faces a couple of problems. One is theoretical, and I won't say much about it, but most underlying models by economists of banking are models about differences in the information that bankers have about projects to which they lend and depositors who are putting money in banks. That's a fairly intuitive concept. And one way around that information or kind of asymmetry are kind of demandable debt instruments, checking accounts and other things, that allow a depositor to get money back quickly so a bank can't exploit that. So I worry that while we think we're solving one problem, namely you can't have a run in equities, that was the lesson of the tech bubble, we're doing it in ways that theoretically might miss why we have a bank in the first place. The second piece of that is just a practical concern. I don't see regulators talking anything about taking capital ratios up so high. Now, would incremental changes in capital help? Probably. We should charge more capital based on size in a cross-section and a time series. In a cross-section, that would be a tax on complexity, if you will, of very large banks. And in a time series, it would be what the Europeans call dynamic provisioning. What about shifts in the regulatory framework? Well, I said we've been on one path, and I think we just need to do it exactly the opposite. So the path we're on is this. We detail ex-ante rules. So we have something called the Orderly Liquidation Authority that's a kind of a rule book about large banks. And we have a Financial Stability Oversight Committee that's a group of government worthies. But what Dodd-Frank did, unwisely in my view, is limit all ex post responses. So basically the Federal Reserve would not have the freedom, were we to have a financial crisis today, to take the bold steps it did in Dodd-Frank, nor would we have the easy ability to recapitalize banks. So we've taken a framework that says we're going to work it all out before the fact, so we never have to put the Secretary of the Treasury and the Fed chairman in the position after the fact of doing something. Everything about financial history suggests that's a problem. And an alternative might be, could we think of some simple rules up front that limit contagion? The essence of a financial crisis is a run. The essence of a run is contagion. So can we try to get simple rules before the fact and then have a lot of belt and suspenders after the fact if we miss something, as we clearly will? I said capital is not going to be a complete solution here. There is an argument that banks can't just whine that raising additional capital will reduce their return on equity. This is the econ junkies in the room, kind of Modigliani-Miller kinds of arguments. That's absolutely correct, but also might be a bit of a straw man. Because again, the models of banking that are a workhorse for the Fed, for the academic economics community, are models in which debt-type contracts that we're worried about, run-type contracts, run-prone contracts, are a feature of the model. It's also the case that there is abundant empirical evidence that some borrowers are bank dependent. It's not the case if they don't get a bank loan, they can go float shares or go issue public bonds. That's just not the way it works. And there are a number of studies, by myself and others, that have identified fairly large credit supply responses to changes in bank capital. And there's kind of a logical box here. If we want so-called macroprudential regulation to be effective, this is the new regulatory buzzword with capital, in order to be effective, equity financing must be costly and affect bank capital and bank lending, otherwise it wouldn't work at all. Too big to fail, I think, is one of the big problems that was missed in the crisis. First of all, the flip side of the capital argument, I think, is that to the extent that we're willing to let very large banks fail, the costs of extra capital are much less necessary. And if we're serious about doing this for large banks that are very complex, we'd need a very complicated Financial Company Resolution Act. The Committee on Capital Markets Regulation I could chair. We have an example. There's been a project at Stanford Law School that has another example. There are ways to do this. It is not the case that these institutions simply cannot ever be allowed to fail. Again, the Dodd-Frank approach has been to double down by saying we're going to name systemically important institutions, many of which are standard banks, but some of which are insurers or other financial entities. There is a big fight, for example, on whether asset managers should be systemically important institutions. Again, to me, that is crazy. There's not leverage in that business. This is a mutual fund business. People might lose a lot of their money, but the firm is not promising to pay 100 cents on the dollar like a bank. The problem is, even if we could have a credible, no too big to fail policy, while that will help in limiting risk-taking, it doesn't necessarily by itself stop the contagion if a crisis stops. And again, that's the feature of all crises. So what could be a simpler way to do this? One might be to start out with a very simple before-the-fact rule on leverage. One of the things that has been a consistent predictor of failures in and out of overall financial crises have been simple leverage ratios that regulatory regimes have moved away from more complicated measures, and measures that focus on the market value of a bank's equity relative to its unweighted assets, because markets are very good at assessing banks' risk, perhaps better than regulators. It's here that nuclear power comes in as a somewhat interesting example. If you talk with people who are thinking about risk management in nuclear power, they would say that a breakdown, if you think of it as the analog to systemic risk here, is most likely when the system that they're engineering is extremely complex, where the dynamics are nonlinear and the outcomes are difficult to anticipate and comprehend in real time. So engineers talk about problems of being too tightly coupled, that events just follow one another in very rapid succession with little time to process information. In the analogy here, where we're thinking about banking, I think that suggests more attention to the very simple measures like simple leverage ratios, and some modest changes in capital. Another feature of the engineering risk management literature in nuclear power is the goal of a high reliability organization. And that's supposed to be an organization where there are a lot of diverse perspectives being presented, so groupthink doesn't mislead in a crisis. I would submit to you, we didn't do that at all in the financial crisis. And one other thing I should mention here, on shadow banking, one of the issues is we continue to regulate shadow banking differently than banks. We focus a lot of attention on names of institutions. Dodd-Frank codifies this. So if you're a bank, you're regulated like this. If you're not a bank, you can do something else. If you wanted to limit the emergence of risk in the shadow banking system, you need symmetric regulation. So for those of you who are in this world, it would mean regulating the haircuts in that market, much as the Federal Reserve regulates reserve requirements on the banking side. We could do this. The Federal Reserve has the power to do it this afternoon. One issue in the approach we've taken to regulation is the tools that could fight contagion if it breaks down have been limited sharply by Dodd-Frank. So the idea in Dodd-Frank was the Fed should not have been able to step in as a lender of last resort. There are many ways one could criticize the Fed's behavior in the aftermath of the crisis. But I don't think it's reasonable to suggest that whoever the Fed chairman is should be shackled by a view that there's no intervention by the Federal Reserve as a lender of last resort. That's why we founded the Federal Reserve. The second limit is on Treasury capital injections. So the Secretary of the Treasury and the Fed chairman will have to go beg the Congress for this. That is a slow-moving process, and I think one likely to lead to mischief. We saw the odyssey in the past crisis when the Treasury started first with a very complicated scheme and then eventually moved to capital injections. If we were that slow again, I think we'd be in trouble. So where I wind up on all of this is saying we need to change from 3 R's to 3 C's. So the 3 R's, again, were run, risk, and regulation. Runs are the essential feature of a crisis, the mispricing of risk and regulatory contribution. 3 C's are first conversations. I think my takeaway from the Queen's question was not so much that somebody could have been clairvoyant, but we weren't even having the conversation. If you think about people in the academic community working on finance, very rarely were they actually having a conversation with practitioners about the instruments that were being developed. That simple kind of conversation, which I think was the nub of the Queen's question, would be very important. We also aren't tackling very big questions. Like, we think so much about little rules and being inside the box. Why can't we study bigger questions? So why can't we say, what would it truly be like to eliminate too big to fail? Why do we give a tax benefit to leveraged finance? There are proposals that have been made by candidates in this election to take that away. Why can't we ask these bigger questions? The second C is, again, to go back to contagion. Stop yammering about rogues and stop yammering about interconnectedness, and note that every financial crisis is about contagion. And so let's look at the actual contracts that are leading to that contagion and how do we fix them. And then finally, the closure of all of this. I suspect in Washington, the closure is something like Tales from the Crypt. So in Tales from the Crypt, you're going at the guy with one firm knife stab into the heart, maybe making the sign of the cross over him, and he's dead forever. That's the way Dodd-Frank views the problem being solved. My fear is very different. It's really more like Agatha Christie's And Then There Were None. Now, I grew up in a small farm town, and so one of the great joys for me was reading Agatha Christie books because it was always posh and rich people and castles, very different from my life. And Then There Were None was fascinating because you have a dinner party and a murder. And that put a damper on the party. But once the body's cleared and the champagne is poured, the thing gets going again until there's another murder, and then another. And you can tell by the title where the story goes, and Then There Were None. The mistakes we're making in regulation are more like And Then There Were None. We're misdiagnosing the problem. In the movie, there's a murderer in this dining room. People keep dying. And instead, we're just letting things roll off one by one. If we really want to fix this, we have to step back and say, let's keep things simple. Let's focus on where the problem actually is, and then give enough flexibility to clean up a mess when it happens. If we do that, I think we will have made progress, and I don't think we'll be talking about another huge financial crisis if we got together the next time a director is appointed 20, 30, 40 years from now. So with that, I'll wind up, and I'm happy to take your questions. Okay. Okay.
For me, pretty fascinating set of topics that were covered. So Dodd-Frank happened over 5 years ago now, and there have been some modest changes to it since then, some of which you alluded to here. And it's unlikely there will be anything major in the next, let's say, 18 months or so. I'm curious, if you were to think about opportunities, low-hanging fruit for policymakers, like last year there were changes made to Dodd-Frank that were added to spending bills that were ultimately passed that changed the regulation of derivatives, for example. Are there things that leap out to you in the framework that we now see that are especially, would have a high bang for the buck in terms of benefits?
It's a great question. I'd say two things. One, there are technical fixes that can still be passed. So last year, not to be too in the weeds, the Collins Amendment, which would have treated insurance companies different from banks, was passed. The Fed thought it was being told to regulate insurance companies like banks, but insurance companies and banks are in very different businesses. That didn't make sense. The Collins Amendment clarified that, and I think those sorts of in-the-weeds things can happen. They may not sound important, but for some industries, these are huge. The bigger thing, though, is the regulation process. One of the worst parts about Dodd-Frank is how vague it is. So much is left to the judgment of regulators. One of the best parts about Dodd-Frank is how vague it is, because so much is left to the judgment of regulators. So depending on the regulatory eye, I think there could be a lot of changes made in Dodd-Frank. And don't forget that the Treasury Secretary plays a huge role, because he or she is the chairman of the FSOC, and without his or her vote, nothing happens. So there's possibility of big change, even if the law doesn't change.
Okay, well, great. Well, I have a bunch more questions, but I want to open it up because I know there are a number of attendees that might have questions for Dean Hubbard. Gary. Oh, can you stand up?
Very good articulation presentation. One of the things which I didn't hear, and it goes back to your point, the interpretation of the regulator. So how do we truly leverage the technology and the big data to look at the issues? If you look at the banks and their insurance companies, the decisions they're making are based on the data, and the quality of the data is not very rich. And how do you enrich that data set? And think about, right, if you look at the entire aerospace industry, when the planes are flying around, right, they have that hub and how they regulate. A similar concept, right, has to be truly leveraged in the regulated world to ensure how you mitigate the risk. Maybe you can talk about the importance of the technology and the big data into this equation.
Well, I think it's a great question. A lot of what regulators want to spend time on are very in-the-weeds micro questions. So is this credit particularly good? As I said, in a crisis with contagion, it's less about an individual credit as the fact that an entire class of assets, like the virus in the salad bar, becomes impaired and affected. What I think might be more useful is more akin to what's now called stress tests. So take a hypothetical portfolio and ask how much capital this institution would have to hold against the risks in that hypothetical portfolio. That gets around the massaging that institutions often do in their own value at risk analyses. So I think, again, simpler might be better. I think in some sense regulators are making this hard, and hard in ways that are missing the underlying problem. But what I just said would be entirely not the view of the Federal Reserve System. I mean, they're taking a very different approach.
Okay. Other questions? Yeah.
Thank you very much. It's very excellent. I have one question here. When the regulators regulating the big banks, one of the downside impact is in the security market. When banks are limited to take more risks, they are also losing their power to make the market, which they used to be, which creates a lot of issues for investors, not only institutional investors, but also a lot of individuals whose 401k retirement money is also in the financial market. So there's a lot of talking about lack of liquidity when market is downturn, and no one is on the other side to take the risk because the banks are regulated now. So what's your opinion here? Will that create another unexpected risk?
It is a very big issue, and if you talk to financial service executives and ask them what's in their worry closet about a crisis, what you've said is probably number 1 or 2 on their list. It's certainly the case that the Fed itself has the power to create liquidity anywhere, anytime, at any size, but it has not shown the inclination to think the problem is so severe. I'll give you an example. There's now a huge industry for ETFs. But if retail investors decided they wanted out of ETFs, then there's going to be liquidations in corporate bond markets that are perhaps much less liquid than people think. So I think thinking through this is very important, but the idea of that kind of liquidity risk management is not front and center for the Fed the way it is for Wall Street.
Other questions on this? Yep. Yeah.
Do you feel that the concentration of power in the banks, let's say, the 10 leading banks of the world, and the comparative destruction of community banking is a good trend domestically in the United States and also in the world, so that we are more comparable to Great Britain, where you have 5 or 6 great banks, and perhaps the rest of the world? Or do you feel this is a bad trend for the American economy?
Well, as I said in my remarks, I don't have a theoretical view on how big a bank should be. I know that there are people in Washington who think banks above a certain size are a problem and below that size are not. I don't have a way of judging that. I know that community banks play a very important role in the financial system, and that's been a role that's been supported by regulation. To me, the question for large banks is we just shouldn't be doing anything that subsidizes their being large and complex. And to me, the number one thing we're doing that encourages that is too big to fail. And we're naming names, and we're saying these institutions will be wards of the state in a crisis. That, to me, is a problem. So as long as somebody's large because they're more efficient, they're more effective, fine, in any business. But one shouldn't be large for that reason. And one thing that worries me is if you're looking at margins in some areas, the lack of entry in banking is leading to rising margins in some of the large lenders. So while they're whining a little bit about Dodd-Frank, they've also used the regulatory process. So going back to my first slide on the good finance, the good finance is not to make people on Wall Street rich. The good finance is to get that money from all of us as savers to entrepreneurs.
So I have a question for you that follows a bit on one of the earlier questions, which is has to do with Dodd-Frank at a high level. One of the goals of it was to try to perhaps reduce excessive risk-taking. So in other words, perhaps not give the Fed such extraordinary powers and the FDIC, change what it could do. And I wonder, the cost of doing that is then you're weaker if a panic comes along. And I wonder is it your sense from what you've read, from data you've seen, if it's made any progress on that front? Like on balance, it seems that you think that any benefits on that front are more than outweighed by hands being tied in the future. But has there been some movement on that? And then interacting that with this issue of, with a low rate environment that we have, is that sort of acting as a countervailing force to potentially, that with low rates, banks and others may have an incentive to go after higher risks than otherwise?
Yeah, one of my graduates, certainly my richest graduate, Warren Buffett, has said that you don't know until the tide goes out who's swimming naked. And low rates are like that tide. And so once we see normalization, we'll find out who's just been living off of that and who's not. I don't think we've reduced materially ex-ante risk-taking, and I worry that the logic of tying the Fed's hand is like saying, if somebody came into the hospital with a heart attack, if the doctor said, I told you to lose weight, and I told you to stop smoking.
Right.
Well, all those things might be true, but I don't think we'd call that prudent risk management. So I think we want the Fed to be able, after the fact, to clean things up. And if we want to clean things up before the fact, then I think we need simple rules.
Right. Other questions? Yeah. Right here.
A run on an illiquid asset can be really disastrous. Do we really know the difference between a liquid and an illiquid
The
asset?
second part of the question is exactly what I was about to say. People talk about liquidity as if it's some inherent characteristic of an asset. It's not. It depends on a lot of macro factors. Something that's liquid in one environment can become very illiquid. The problem in a financial crisis is once you start a run, you can widen the scope of what becomes an illiquid asset because so many people are trying to run for the door. If each of us thinks we're in a bubble, but we'll be able to get out before the others, that's naive when we all start to run for the door and can't get out. So part of the problem policy has is I don't think you can define an asset as intrinsically liquid. There are differences in degrees of liquidity in good times and in bad times, but nothing is intrinsically liquid, maybe save treasuries.
Additional? Yeah.
Do you have any comment on Al Scott's proposal to the CCMR to optimize the penalties the government has imposed on financial institutions?
The question is about Hal's proposal to limit the penalties. I'm trying to, if I'm understanding your question, he's proposed, not using so much of a penalty structure, but just trying to get the rules right. And if that's what you're asking, I absolutely support that. In fact, it's my name, it's the signature on the bottom of his proposal, so I support it.
Question over, there was a question over here. Yeah.
So following up on the comment of regulations' impact on liquidity and your observation of widening spreads for a lot of financial institutions, my question is, as you weigh your proposal versus the status quo, how do you measure the impact on growth? If you make the financial system internalize a lot of costs, they just pass it on to the consumer, the borrower. We slow down. How do you think about that measurement?
Well, I think there are two issues about cost. So one thing I think we want to pass on to the consumer are inefficient ways of doing subsidies in the past. So if you tell me that if we have a more rational housing finance and the GSEs are reined in and the marginal cost of housing finance might rise, I'm perfectly okay with that. I think that's a better outcome, just like I would rather that debt not be preferred by the tax code over equity. What I don't think we want to be pushing off is enormous tail risk onto individuals and taxpayers, and that's where the rules approach, I think, has some salience. But I do think, we are going to see some things be more expensive, but that's what happens when you stop subsidizing something. I realize that's not a politically attractive answer, but I think if we're not going to make that change, we're never going to get out of the problem.
Okay. Josh?
So thanks for a great talk. Simple rules sounds like a very good prescription. Of course, they're really complex financial institutions, and I wanted to ask you, do you think there is hope for stress tests to be able to detect the potential for the kind of tail risk that we're most worried about, particularly when so much information by nature has to be provided by the banks themselves?
It's a very good question. One comment on tail risks that by naming institutions as too big to fail and not having a credible way to lean against that leads these institutions to engage in behavior that I would describe as picking up nickels in front of a steamroller. It's profitable until the steamroller catches you, except in this case, the steamroller is actually going to catch the taxpayer, not the institution. So I think the first step is to get rid of the too big to fail. I think if you had capital requirements that moved over space and over time with size, you get at some of this too. If I tell you that as your balance sheet grows, you're like a progressive tax, your capital ratio grows, then I'm telling a business person, you make whatever management decision you want. Just know that we're going to tax it a little more heavily. So that would lead large banks to hold more than small, and over time, something like dynamic provisioning. I think that's better. On stress tests, I am fairly optimistic, not literally what the CCAR tests are now for banks, but doing something that is more similar to what's done in the UK of taking the kind of hypothetical representative portfolios and looking at capital for this institution against that portfolio. Nothing's perfect.
Yeah.
For better or worse, we have Dodd-Frank here in the U.S., and there are some international agreements like Basel III. But I'm just wondering how you feel about global coordination among regulators and whether that is helping or hindering the prudent regulation of financial institutions in the wake of the financial crisis, because not every country is dealing with it the same way.
It's a great question. A couple things. We know that in the financial crisis, this was a really big problem. So part of the problem in Lehman was disagreement between regulators in the UK and regulators in the United States. Regulators have moved globally to this college approach where they're getting together in advance to talk about systemically important institutions at least. And that to me seems like a pretty good development. And I think we do have to have global standards. The problem is you thrive globally, but you fail locally. And so you really do have to make sure that somebody knows who's actually holding the ball in the event of a failure. And that was part of the problem with Lehman.
Okay, well, I think we're going to have been told we're
Under the
at
Chauvin
an hour.
rule,
Right,
it's-
that's right. So I want to stick to the Chauvin rule. So please join me in thanking Glenn Hubbard for coming all the way out. See ya.